Better than 2 points. So, 20 points on the Nifty. Sensex is, it's like we started day before yesterday. Massive 2 points.
Massive 2 point change, yeah.
Well, 85 points on the Sensex. 83,600 is where the Sensex is at. The Bank Nifty is up 80 points, 85 points. The Nifty Mid-Cap Index is up about 40-odd points or so. So it is what it is. Actually, yesterday everything was slightly on this. It was not sliding or anything, but it was down to sideways, except the small cap index, which ended with about a 0.5% odd gain yesterday. So that is, of course, thanks to some individual names there. A broader, the Nifty heat map, as you can see on your screen, 35, 36 names are up, and the rest of the stocks are actually lower as we begin this session. I can spot Pharma, and I can spot some IT there with Pro. As well. So that's the overall picture. It's a very well-behaved, slow 5-point change on the Nifty.
Okay. TCS, very quiet ahead of earnings, 0.3% lower. Even Infosys, 0.5% lower. So, there's no exuberance or excitement in the IT names. We haven't seen that kind of a build-up at all. Actually, even for the month, if I look at TCS, it's done nothing. It's down to 2.5%. So unlike some of the previous quarters, there's no positive build-up on large IT ahead of the numbers. Let's see what else is down. Reddy's is lower, Cipla's is lower, Sun Pharma is lower. So Pharma is not too hot this morning. Market is now absolutely flat, blinking red and green. On the upside, some of the financials are looking quite okay. Shriram Finance, 0.5% up. Axis Bank, 0.5% up. Bajaj Finance is not too bad. ICICI Bank is up. SBI is at least having a positive start in the green. And Reliance was fairly volatile yesterday. It's sitting on the fence right now with just about a 3 to 5 rupee up move. That's Reliance Industries. Tata Steel is the best performing stock on the Nifty for the moment with a gain of 0.7%. And now we're struggling to do 1 point or 2 points also on the Nifty. So back down to flat.
Not fair, guys. I go third. So, by the time you come to me, it's already flat. The 20-point gains have gone. But, a few stocks in the broader markets are buzzing around. Nvidia Infra Engineers, the JV bagged a 390 crore project. So the street likes it. That one has been doing well. It's up close to 4.5%. Volume's fairly decent. SPML Infra, that's another stock I was looking at. In the last few months, the stock has moved, I think, from around 180 to 280. Today, it's up close to 10%. So that's coming one of the top volume gainers out there. PFC and REC, I think there's a brokerage call that's coming in there. A couple of them have mentioned that post this recent correction, actually, it's providing a good entry opportunity. So explains why both these two names, in fact, have perked up in trade. On the flip side, you have Quick Heal. That's falling on decent volumes, actually. That's down close to around 3%. I'm not sure whether or not there is some news flow on that one, but that's down 3.5%. The other one you're looking at is Metropolis. That as well is seeing a bit of a knock in today's trading session, so just keep an eye out on that particular name. And Dream Folks, post this news that's come out with regard to some of those, clients they've been losing and it's impacted their business. In a month, the stock has gone from 270 to around 165 rupees or thereabouts. So difficult times for this one.
It is absolutely the case, difficult times. Markets, though, I think now are down, 3 points, 3.5 odd points in terms of the change, as you can see up on your screens. We'll talk about individual sectors, names, etc. as we go along. Now, Dream Folks, I don't want to talk about the stock per se. I don't know if you have a view even, but what do you make of the entire it kind of, not in a straightforward way, but talks about the lesser talked about variable in every sector, which is the big, the competition risk in that sense. Here, of course, it's disintermediation, if I can call it that.
That's right.
But any thoughts at all here?
But I think that what you're saying is true. No matter what sector you're in, there is disruption, and if it's not from competition, it's either from technology or AI that's coming in as well. And I think the IT sector in particular is vulnerable to that. That's a real problem in this country. I mean, you could have an irrational player come in and actually damage the industry and take away market share, and survive for several years before cleaning out the competition.
And this direct quick commerce, I mean, just to sort of hop from, again, I thought of it because of competition again, right? Zepto, for example, yesterday it said they're raising money.
That's right.
More money. At
a higher valuation.
At a higher valuation. So,
No, I think quick commerce is here to stay. I mean, our view is, my boys don't order anything anymore. They haven't been to a Kirana store ever, I think. I should probably drag them out of the house once and take them. And this is what a real store looks like, not the one on your phone. But the fact is that, it's here to stay. And people, I think, are having less and less patience, whether it's short reels that's causing that to happen, or it's the OTT platforms. But people want instant gratification. So if you order a toothpaste, you want it in 10 minutes. You don't want to wait an hour for it.
The reels are the biggest disruption, I think, for mankind in general, at several levels.
Good for customers, good for shareholders as well?
Shareholders of Zepto or
I mean, the entire space, Zepto, Eternal, Swiggy, do you think, because I'm very, very happy, using the services.
Yeah.
But as a shareholder, would you say that the better time's coming for them?
Yes, because they are taking away significant market share from the Kirana stores.
Yes.
The Kirana stores, of course, there will be some political ramification at some point when they say that, these guys are hurting. They are already hurting, but maybe they hurt even more before somebody takes up their issue. But the reality is, they're here to stay. So probably definitely good times. But specific on Eternal or Swiggy, the competition is so intense, much like the paint industry, where you're seeing large organizations, large industrial houses getting into the business. I don't see how the economics necessarily will continue to be strong.
So Gautam, now put it all together for us. And we haven't discussed the global backdrop, which is amazing because you look at the US market, with wars and with so many headlines, tariffs, it's just going up and up, at least for now. That so-called, great gush of FI liquidity doesn't seem to be making its way to our market anytime soon, at least on a more durable, permanent basis.
Yeah.
Coupled with everything that we've discussed, earnings expectations are low, valuations are high. So what should an investor be doing here in India?
So let's understand what's driving this market. It is pure fund flows, okay? And you got to hand it over to the Indian domestic investor, continue to put money month after month after month. I mean, yesterday's number was, I think, a big shocker to me personally.
23,500, yeah.
Well, that was a net number, but the SIP was 27,300.
Yeah, SIPs are fantastic.
So that's obviously a new record high.
Yeah.
So let's see what's driving that and pertains to what's happening back in the States. If you look at here, you're looking at extremely low savings rate. HDFC's, and I have an account with HDFC Bank, their savings rate is 2.5%. Fixed deposits, 1 year tenor down to 6.25%. So would someone like me be incrementally putting more money in the equity markets? Probably yes, to try and beat fixed income returns. Secondly, if you look at the average age of the investor, I was looking at the NSE Market Pulse, and they have some pretty interesting raw data in there. 40% of the investor base, unique investor base, is below the age of 30. 70% is below the age of 39. If you look at the top 5 states, Maharashtra, Gujarat, UP, and Rajasthan, and West Bengal, this is where the top, about almost 50% of the unique investors come from. If you look at incrementally, where are the new investors coming from? Include states like Tamil Nadu and Bihar. So the equity culture has only just started. I mean, there's more to go, more states to hit and penetrate. So I don't see that slowing down from India perspective. Yeah. As far as the US is concerned and FI participation is concerned, the fact is our market's trading at the same valuation as the S&P 500. FIs, when you look across Asia, for example, you got earnings growth that matches ours across Korea, Taiwan, and China for this year. So we're not cheap. FIs have more options to invest in, and the earnings growth back home in the US is huge. Yeah. First quarter, calendar 24, S&P 500 earnings grew. All 500 companies' average earnings grew by 12%. And that's 28% for the Max 7, 9% for the balance 493 companies. So that's huge earnings growth, and we don't have that here.
Yeah, explains a lot. So what should one be doing? I mean, in terms of, like you said, as investors, I mean, we need to be in the equity market for the reasons you just mentioned.
That's right.
But we have all of these headwinds. So where should that money be put?
Money still can be put in the equity markets. Doesn't seem to be an alternative. I mean, gold's the other option in terms of an asset class.
Where in the equity market?
So here's the thing. I know you're going to pin me down on that, but the reality is, of the 1,200 stocks, we ran this screen only last week, of the top 1,200 stocks by market cap, 890 stocks over the past year or so are up 25% or more, which means 300 stocks have underperformed. Second, and more importantly, if you look at over the past 2 to 3 years, there are total sectors that haven't performed at all. I mean, we discussed shoes, we discussed QSR, with the exception of one or two companies that have actually done well. I mean, even TCS over the last 3 years has given us mere 6% return. So there are a lot of sectors out there that haven't done well. And I think the other element to look at are companies which are undergoing a special sit. So we run a public market fund, which is a special sits fund. So you're looking at Ps getting into in terms of ownership or taking chunky stakes. We've seen a lot of that happening over the past several years. You're seeing promoters sell out. That's a big theme. M&A happening in the industry. So there are a lot of chunky things, deleveraging happening. So there are a lot of opportunities that are actually there, but you got to roll up your sleeves and find them.
All right. Gautam, final question from mine before I let you go. I recall being at a cement plant to visit more than a decade ago, and you happened to be there as well. I think I was the only business journalist that managed to sneak in there.
Yeah.
And the street is optimistic. The second half of the year is going to be better for cement companies. And, to be fair, price increases is something that's been good. That's been the lone positive. Hopefully, demand catches up as well.
Yeah.
What's your view on this theme? And do you believe some of these smaller cement players or the ones that have underperformed in South India are better placed?
Yeah, so I think cement's a very regional business. So South India traditionally has not been best in terms of pricing power.
Absolutely.
We haven't played a cement theme as yet. We played it more through construction companies and other ways to play cement. But is the horizon bright? I think the horizon is indeed bright, but it's not going to be, EMS.
So that's not one of your preferred sectors.
It's not a great preferred sector as yet, but it's not going to have great earnings growth. But I think there's consolidation happening, and hopefully that's going to give it even more pricing power.
All right. EMS, you just briefly mentioned that. That's a theme that you've liked in the past. It has a big runway ahead. Valuations, it's debatable where exactly the stocks are at. But would you be looking any kind of bad news to buy into some of these names? Stocks like Dixon, you've had various contradictory reports in the last couple of months.
Yeah.
Some very positive, some very negative. But, 1,350 odd, where the promoter offloaded some stake, that seems to be the zone. It goes there, it bounces back very quickly. Your take?
Yeah, my view is not specific to Dixon, but my view is that EMS is a growing industry. You're still seeing Dixon as an example, giving 80 to 100% quarter-on-quarter top-line growth.
Yes.
So my view is that this is an area one needs to remain invested in. Will the valuation sustain? And that's really something you got to think about. 70 times, 80 times. Some of the other names which are tier 2 versus Dixon are trading at half the valuation. So those are interesting too.
You want to name a couple of them? I think Sirma is one stock that we had discussed in the past.
We don't own it anymore. We own Amber, so that's something we're building a position in. So full disclosure.
Okay, all right. So some ideas finally. See, Nigel managed to pin you down.
I know.
Let you go.
Drinks on me.
Thank you so much, Gautam. Great conversation, and thanks so much for stopping by at the studios this morning.
Thank you.
All right, well, that is the market construct. The market, by the way, is now down 21 points. Mid-cap index is flat. Bank Nifty is also flattened out. Continues to be very, very quiet out there. So for the time being, let's put the spotlight on the textile sector. And that's in very, very sharp focus because hopes are running high. Hopes are running high with the expectation that perhaps India will eventually get a more favorable deal and a more favorable rate of tariff than some of the biggest competitors when it comes to apparel and textile. Competitors like Bangladesh, which is at 35%, Vietnam, which now we know is at 20%. So what awaits the Indian textile story? Well, joining in to talk about this, we have Mr. Sudhir Sekhri, Chairman of Apparel Export Promotion Council, as well as Pallab Banerjee, Managing Director and Group President at Pearl Global Industries. Gentlemen, thank you very much for joining in. Mr. Sekhri, if I could open with you, and this makes me a little nostalgic because I started my journalistic career reporting on textiles and apparel, and this was way back. I don't want to reveal my age, but we're talking about the era when, WTO quotas were ending and India was supposed to seize the opportunity in apparel. We did it to an extent, I think, in home textiles and, linen and towels, etc. But then countries like Sri Lanka, Vietnam, and obviously Bangladesh stole a march over us. Now, what are we looking at? I mean, we don't know the final tariff that India gets. There's also the India tariff plus a BRIC tariff. So maybe it's 10 plus 10, 20%. We don't know. But looking at 35% on Bangladesh, do we have a real chance of, a major milestone turn when it comes to our apparel exports?
Yeah, okay. Thank you for having me over. Well, you're right. We have over the past few years, we have been laggards, so to say, and as compared to our neighbors and competing countries like Bangladesh and Vietnam. And that's because of the policies that, Bangladesh, for instance, has an FTA with EU, which we don't have. So they have a huge advantage. Most of the EU retailers, they source around 50 to 70% of the apparel from Bangladesh. So that's a big setback for us. But I think that is going to be addressed very soon once we sign on the dotted line with EU. Coming back to the US, yes, the signing of the FTA has again been and will give impetus to our the apparel trade, and with the BTA with the US in the offing, I think that's going to be a game changer for us. And we believe that we had AEPC had set a slogan 40 by 30. And I think, what the events which are happening, the BTA, the FTA with the EU, that is really going to take us on that ride of 40 billion by 2030.
But Mr. Sekhri, let's also talk in terms of, numbers. And we can only play out scenarios right now because we don't have the final tariff. If I remember correctly, I think our current blended tariffs for apparel exports to the US is somewhere around 5 to 7%, I think 7% from what I gathered. Correct me if I'm wrong. Now, if this goes up to 10%, which is current baseline, if we somehow manage to escape this additional 10% brick duty, what does it mean for our apparel volumes at 10%? And if Mr. Trump levies the BRICS duty as well, which means we're at 20% tariff, then what? Then it could be a setback, won't it?
Surbhi, the numbers,
First of all,
the numbers, I don't know, because I remember Gokul Das, I have, when we spoke Gokul, they said that US already imposes 15 to 30% on apparel imports.
On Indian apparel imports.
On Indian apparel. So the range, it depends on what item, but between 15 and 30.
Okay.
And then there was 26%. So it is 26 plus at least 15, if not more, already. I mean, currently.
Yeah.
If you just take a look at what was announced on Liberation Day. And now we're talking about change from that point. So it's already pretty steep. I mean, 35, 40% if based on Liberation Day tariffs. And now we're talking about whether it's going to be higher or it's going to be low. So just that caveat.
Secretary, just weigh in on this as well. I mean, since you represent the whole sector, the average tariff pre-Liberation Day and where we could be looking at the various numbers that are doing the rounds right now.
Okay. Let me first tell you what is when you talk about pre-Liberation Day, that's called MFN tariff. Okay.
Yeah.
The MFN tariff ranges from anything from 2% to 32%. Depending on the category. It's line-wise. It's not a same rate of tariff for every product.
Correct.
Especially for man-made fabrics, it is much higher than for cotton. So on an average, what your colleague just said, on an average, it's about 18%. Okay. Now, with the 26%, which is not going to happen, quite honestly, this 26, the 26% tariff is not going, reciprocal tariff is not going to happen. We are looking at something between 10 and 26. Now, based on our conversation with the Ministry of Commerce, apparel, it's because it's being a labor-intensive industry, that is a top priority for our government. And they are, they will go all the way to ensure that our industry is not hurt, because if our industry gets hurt, it hurts our employment potential also. So the government is aware of that, and they are very supportive of the fact that our industry needs to. Now, coming back to, see, when you talk about compare with Bangladesh, now Bangladesh was just hit with, I think, 30%. 35%. 35%, okay? Even if we, as a worst case scenario, even if we go to 26%, we are much better off than them, okay? Now, our other competition is Vietnam.
Mr. Sekhri, sorry. So then if in the worst case, what is the tariff, effective tariff then?
Effective tariff will be MFN plus 26% before the BTA gets signed.
Yeah. So in India's case, it's average 18 plus 26, right? That is 44%.
Yes.
Then.
And Bangladesh would be MFN plus 35.
Which is what?
You see, MFN, first of all, please try to understand, MFN stays there.
No, I'm saying what is that effective tariff for Bangladesh against our 44 in worst case? What is their number?
35 plus MFN, which is 18 plus 35.
18 plus 35. Okay, so even then it's going to be lower. But you're saying In our case, your expectation is going to be 18, which is the average, plus something between this 10 and 26%, right?
Here I'm being very, very pessimist. Otherwise, I think, based on the assurances that have been given to us by the government, I think some lines may even end up with 0%. When I say 0%, please realize I'm not talking about MFN. MFN is something that Mr. Trump can't do anything about. This has to be done by the Senate and the House of Representatives. Okay, that is
in the case of Vietnam, sir, Mr. Sekhri, what is that number?
It's 20% plus MFN.
So that is 38%.
Yeah.
Okay,
right.
so it's kind of it's all coming to in that 30 to 40% kind of range so far, what we've seen, right?
That's right.
You're saying we should be better off.
We will definitely be better off on certain lines. On a few lines, perhaps, because we are negotiating. What the government is trying to do is, on a slow-moving lines, let it be a little higher if they wish to. But on the fast-moving lines, they will definitely gun for a lower reciprocal tariff.
Okay, got it. So that kind of clears up the numbers that from an MFN perspective, we were at 18% average for apparel and textile exports. Now we need to see. So MFN 18% plus question mark.
Reciprocal tariff, whatever it is.
Yeah, whatever is eventually decided. Now, whether it is 10 or 20 or 20, not 26 like you're saying. Got that. So that clears the math. Let me come to Mr. Banerjee as well. Mr. Banerjee, I mean, you have large operations, and I mean, a business like yours, I guess to an extent you've already de-risked because you've got facilities, I believe, in Vietnam as well. How would an exporter like you, how are you preparing for all that happens? And for your own business, now that Vietnam tariffs have also gone up, what does all of this imply?
Thank you, first of all, for having me on this show. So if you look at the whole manufacturing and the sourcing sector across for this textile and especially for apparels, the biggest country of exports is in China, followed by Vietnam and Bangladesh. These are the three topmost. And then, of course, after that, we have got countries like India, Indonesia, Philippines, Turkey, all these countries who manufacture that garment. And they globally, even if I speak specifically for USA, they have been sourcing from these countries. So whatever they do, immediately a shift would be difficult. For example, like if India, all of us are hoping that get a much better deal. In that case, over the next few years, we have to really ramp up our capacities and capabilities as a country to service this huge potential. Currently, this potential is lying in countries like Bangladesh, Vietnam, and China. One thing is very clear with what's happening from the Trump administration, that de-risk what was spoken about in the in the 15s and 16s and 2017. Now it is becoming more like a decouple. So naturally, as the business moves from China, the two countries which are benefiting or has been benefiting in the last few years have been Bangladesh and Vietnam, which taken the maximum benefit out of it.
But Mr. Banerjee, that's exactly what we're trying to understand, because obviously, in line with perhaps smart business positioning, Pearl, for instance, and I'm just taking this as an example, you already had set up facilities in Vietnam and in Bangladesh. If you could just tell us from your current revenue, how much is coming in from your plants in Bangladesh and in Vietnam? I mean, as a rough percentage. And what happens now? Because suddenly the exports from these geographies become uncompetitive. Or maybe, I mean, it's kind of more difficult with respect to those higher tariffs. India will talk about in a bit. Yeah. But what could be a potential hit to you, given the rise in tariffs in both of these countries where you operate?
Yeah, what we are seeing is definitely a positive traction at this point of time. Bangladesh has an advantage because of LDC status. They had a duty-free advantage to the European Union, UK, Canada, China, they have for ASEAN, and a lot of these kind of benefits are there. Like Australia is also a duty-free for them. So that become a hotbed for apparel. And that's why that country, if you see like almost 85% of their exports is in apparel and to all these countries. So what we are seeing is that positive traction continues. If this US, they have given a time till 1st of August to renegotiate, and if Bangladesh can't do anything, then we will see some migration of the US business from Bangladesh to countries which is more favorable. That is one.
Can you
of
just
the
give us an
potential-
estimate? Yeah, absolutely. Got your point. So some of the other countries, I think you'll keep exporting to them, EU, etc., like you mentioned. Out of your total exports, how much is going to the US? And within the US export number, how much is going from India and how much would be Bangladesh and Vietnam?
Yeah. So US is about anywhere between 48 to 50% of our total revenue.
Okay.
And if I look at Bangladesh almost about 70% is going to the non-US countries because of the duty tariff benefits that we have for the other trading partners of Bangladesh. And if you talk of Vietnam is a very heavy for US. And if you see like the negotiation that Vietnam government did with US, some of these US retailers were part of that discussion. So naturally, there's a lot of interest from the US buyers to secure their trade with Vietnam or countries like Bangladesh and Indonesia and all. So that's something we saw happened in Vietnam. One of the things that we heard from Treasury Secretary that maybe this number, what they talked about is 20%, is independent of any other tariff. So we don't know as of now because it's just an interview I think he gave with CNBC day before yesterday. Now, what is the actual fine prints, how it comes out, all those things industry is awaiting.
No, absolutely. I don't envy your position at all. I mean, I can imagine the sleepless nights just wondering which tariff missile is going where, and you have hard assets on ground, businesses on ground. So, Mr. Banerjee, just to sum it up, for the current year, FY25, can you give us some guidance or any guidance at all? I mean, will there be growth? How much growth? Are you scaling back your projections because of all this uncertainty?
No, you see, the industry, humankind has to wear clothes, whether it's US and other markets.
Till we find a way not to.
So what we have
well said.
That definitely, the first deal that has happened.
I'm just kidding. I should introduce some levity into the conversation since Surabhi said both of you are having sleepless nights. Go on, Mr. Banerjee. Go on.
So what we are seeing is definitely with this complete deal, as per the US president says, that has happened with Vietnam. So we are seeing a lot of positive traction because of that. I think what we are seeing is that the whole year at this point of time, the capacity is getting booked, a lot of interest from the retailers and all. With Bangladesh and India, still in a question, some of them are in conversation with us. They're saying that, okay, we should give them the flexibility. If whichever is lower in terms of tariff, we should be able to move and show that flexibility of moving the production to that country. So this is the kind of conversation that is going on with our customers on day-to-day basis.
All right. Thank you both for joining us. It's a pleasure having you here. Appreciate you sort of coming on. And I must urge both of you to join us when we actually get the rates. I think it's a fascinating, insightful conversation we've had. And I think we got to learn a lot. And so did our audience, I'm sure. Thank you very much, Mr. Sekhri and Mr. Banerjee, for coming on here on the program. Well, the next conversation is very much about the markets themselves. I mean, we're not talking about companies listed on the market. We're talking about the market, stock exchanges as a business. We have Metropolitan Stock Exchange, which is on our radar. Why is that on our radar? They've announced that they're raising 1,000 crores in funding. There are venture funds, brokers, AIFs, which will be investing and putting this in total 1,000 crores. And this is the second sort of round of fundraise that we've seen come through. To talk about this fundraise in detail, but of course also talk about the timing of this and what the bet really is here, we have Latika S. Kundu, Managing Director and CEO at Metropolitan Stock Exchange right here in our studios. Ms. Kundu, great to have you with us here. Thank you very much for dropping by. So I want to start with, there's a very interesting time that you're doing this because there is so much focus, regulatory focus on what has been the single biggest growth driver for the market expansion, which is the options market, right? A lot of regulatory focus. I don't need to go into the details. We all know that. And yet you're able to get about 1,000 crores, a new funding round from some marquee investors and a bunch of brokers, market makers, etc. as well. What's the pitch that you have for them?
Well, I'll take a step back before I get into the pitch. And that is, the larger purpose is always that we are able to create markets which are for investors, which are healthy, which will be more inclusive, which will be able to create a competition. And I think that's the one thing that's still lacking today. We can see a near monopoly on the cash side of the market, a duopoly on the options. I know everybody's focus is on the option side of the market, and that sounds very exciting. But looking forward, we see to growing a sustainable exchange. And for that, we need the cash market to be equally healthy and to be taken care into a deeper penetration across all strata. So we're looking at a mix where we will have the institutional, the retail, a mix of all types of investors, because the entire focus is not just about having one more platform. It's not that. It is about actually wealth creation into the country.
No, that's the baseline. That's the baseline that we work with, and then we kind of sort of, that need be said. I mean, that's understood. But Ms. Kundu, I'm sure you have Tuesday as the expiry.
Yes.
The options expiry day.
Yes.
Right. I mean, that's a powerful card that you have when you went and raised this money. I'm sure. I mean, without that, I mean, I doubt whether you would have gone to the market and been able to raise the money. So it is still for investors who they're looking to raise money, really. So what is your strategy going to be? How are you going to do it? As you said, it's a duopoly right now. There is NSE, there is BSE, entrenched players. Exchanges globally are also very strong network effect players, right? I mean, something which does well, continues to scale, does well because it is doing well. So in a way, benefits beget benefits. So just what will MSE do in that sense?
So in that sense, of course, we had, you spoke about why they came in before the Tuesday. Some people spoke about the first fundraise, them coming in on the exclusive Friday, which has now become a common Tuesday. So I think the larger picture is about, seriously, yes, options market, we will be penetrating into, because we do have an exclusive index, SX40, which lies right between the Sensex and the Nifty. And we see that as a very opportune benchmark index, which does have its own features and qualities, and it sits right in the center of the 25 and the...
So MX40 is the...
SX40.
SX40 is the index?
Yes.
And everything will be underlying
40,
on the...
Yeah, which are the large 40
and
caps.
how does that derive its prices from? Because...
So, of course, that's the reason I said that, looking at the sustainable exchange, we would be saying that, it's the cash market that we look at as the primary focus to start with, to bring in the liquidity. And as I said, it's a near monopoly there, because for us as market creators, we need to look at it in a more holistic way. Do I have a healthy market? Is it competitive enough? Am I providing enough to my investor? Am I really reaching the goal that the regulator and the country is looking at from a longer perspective? So to do that, focusing just on one options market will not be sufficient. And that is not what we are only looking at.
Is there a message you've got from the... I'm sure you've been in touch with the regulator, etc. as well.
We firmly believe in.
Okay.
This is a message that we firmly believe in, that,
So cash before options? So
Cash before, yes.
Has to be.
Yes.
All right. Hi, ma'am. Thanks a lot for joining in. A couple of basic details then. If you could tell us, most of the companies are listed either on the BSE or on the NSE.
Yeah.
Could you tell us what is your strategy with regard to getting larger number of companies listed on your exchange? If you could help us out with that, what is the strategy out there? Also, if you could give us a few more details on numbers, number of companies, number of members that you have, broking members. What was it, say, 3 years ago? What is it now? Where is it headed? Both those two basic details on companies and brokerage.
Thanks, Nat. So basically, we do have about more than 200 uniquely listed companies which are not on any other exchange.
Okay.
There are, of course, the other larger companies which are out there on NSE and BSE, which are not listed with us, but they are in the permitted to trade category. This is the same for every exchange that starts. It was so in NSE 30 years back, where you started off with permitted to trade category, and then slowly you list on as you build the liquidity. So I think the focus will be, I'm sure at some point they will come in and list, and that will be also our focus for the existing listed.
Okay.
For the new set of companies, we definitely will look at them coming in, having their IPOs with us for the the platform.
Has the feedback been positive?
We do see a lot of interest gathering. Members, we do have more than 560 members which are registered with us.
Okay.
There were, of course, many more at some point of time when we started off 17 years back, and were a competitive exchange. Now again, we're looking at a restart-up model. And we see that will propel through the challenges we have gone through. It's fair enough, but we will look at new companies coming in, listing on our platform, as well as even companies which it could be that in a new category of companies that we may look at that could come in, while getting all the existing companies also slowly coming and listing on our platform.
Ms. Kundu, just want to understand if you can share some milestones, I'm sure some targets that you've set internally in terms of volumes. What are those, by when, how much, if you can give us some sort of timelines, and also how many brokers are with you right now? I think some of them are also investors with you. So if you could just tell us how the scale-up is going to be in terms of getting more volumes on the exchange and bigger participation from brokers.
So we have almost more than 550 odd members who are already registered with the exchange. We are slowly seeing the activation increase. Last 6 months has been a positive turn with more and more members, not only the existing ones activating, but also new members coming in of different categories who are coming in and applying for new memberships. So we are seeing a positive turn on that end. Connectivity is coming in. We have been rolling out new infrastructure. State-of-art data center is what we are going to be now, giving in the next few months. So we are all in the readiness to make sure that we are market ready, future market ready in terms of infra and tech space, so that when members come and connect, the feel-good experience is very much there on the table for them. So that is what we are focusing on.
Advertising blitzkrieg as well?
Sorry?
You will need to reach out, right? Advertising?
Yes, so we will start with roadshow. We haven't really started on the advertising, but we will, of course, slowly roll out an entire PR plan and a marketing plan.
But how will you fund all this? Because I believe in, let us know the numbers. I think the operating income last year was around 4 crores. So as you go about investing in technology and, the exchange architecture, marketing, how will you fund all this?
Yeah, so the first round of funding did help us with, being able to allocate a good amount of number to the tech space, as well as expansion on general purpose and business, obviously expansion growth plan, whether it be including people. So infras, of course, and tech space is going to be the bigger spend. And road shows through other, marketing techniques, of course, we will.
Yeah, in a way, a lot of the brokers who've come in, I'm assuming they've also been, you've brought them on the cap table because, you've got to make markets, right? You've got to have activity. The brokers, etc., should help in that sense. As shareholders on the cap table.
Well, I'm sure that, that is something that brokers do see an opportunity.
In a way, it aligns their interests.
Yeah. I would say everybody is looking at, beyond a near monopoly on the cash side of the market, and also having, in every sector, in fact, just to move even beyond the exchange space. If you see any sector, the more the competition, it helps not only the sector, it helps every participant, including the existing players, because the market size is only there to expand.
It's going to give us a number. It focuses the mind in terms of a target. What Surubi said.
Volumes, your targets, and for your internally, your own revenue and profit estimates.
So I think we are looking at a 3-year horizon from now, where we look at ourselves becoming completely sustainable in terms of an exchange, and also in terms of liquidity. At least within the range of 10 to 12% on the cash segment side of it.
12 to 15%?
10 to 12%
cash market share in 3 years' time.
Yeah. So accordingly, we feel that even the propel on the derivatives would happen. But it will be obviously a slow progression. And while I say that, I think it's not just about the market share. The market size itself is going to grow. I'm looking at we are in a country, we're proud to be in a country where we are just 28 years old. We have a mindset today. We always had a mindset of saving. Today we have the mindset of creating wealth. When that is the propel, so that means I'm looking at a good close to 500 million people at least, who should become becoming proper investors, and having, whether they come through SIPs, they may not come directly to the market. We do understand the concerns on creating that healthy market, and we very much would like to propel that further.
All right. So you turn profitable in the next 3 years is what you're saying? EBITDA positive, market share of around 10 to 12%, and you look to make some entry even in the derivatives market. BSE struggled for around 20 years, but they finally made their mark. So we'll have to see how that goes. Very quickly, that market share is interesting. NSE needs to list, could possibly list in the next 12 months. They'll list on your exchange as well? Any kind of conversations?
That is something I think you will have to ask at Edison. But we are more than happy to have anyone, that is what the markets are for, that you are supposed to list on any of the exchanges. So yeah, why not? I mean, if they do plan that, we are more than happy.
Competition and support each other as well. That's going to be interesting.
Of course. That's the way it should be, because when it's a healthy competitive market, you will all grow. Everyone will grow.
That's a very specific, nice, interesting point, Nigel.
Need to come up with something interesting, right?
No, I mean, given the interest levels in NSE, that could kind of provide the spark. And a new stock, a big one, biggest exchange, listed, and I mean, yeah, as you said, they are supposed to list. I mean, they were supposed to, if they list in BSE, but now with MSE as well, if it's, why not, as you said?
Yeah. Why not?
I mean, investors want a pie of the whole capital market space in one form or the other, so perhaps they'll be tracking your progress as well.
And more the platforms, I think that only allows de-risking also of, the entire space.
Sure. Okay, all right, ma'am. Thank you very much for joining in and discussing the roadmap ahead for you in the exchange in terms of growth. Let's quickly move on and address a very, very important story that our colleague Timsy is bringing about. This is something that oil marketing companies and their investors have been awaiting for a long time. What will happen to those LPG under recoveries? Well, Timsy is picking up from sources that there could be a fund that the government is setting up for this. Timsy, morning. Tell us more.
Well, yes, that's what government sources indicated to us, that the finance ministry is considering setting up a fund which could range between 32,000 crore to 35,000 crore rupees, only to cater to the OMCs under recoveries that are happening on LPG. The Petroleum Ministry has demanded about 40,000 crore rupees for this, but Finance Ministry feels that about 32 to 35,000 crore rupees of fund could be what can be taken up for a cabinet's approval to cater to this demand. And these proceeds, basically, where will this fund come from? Where will this money come from? Well, sources indicated that these could come from the petroleum excise duty proceeds that the government has raised till now. They'll use the excise fund for this. And the view behind agreeing to take this proposal forward for the cabinet approval is that oil companies are part of the same government family, and government cannot let them suffer by themselves. Their demand is justified and they need to be catered to. Thus, a compensation can happen very soon. That's what government sources, senior officials indicated. So let's see what happened. What happens now, how soon this proposal goes to the cabinet, because Finance Ministry is just finalizing the contours, and soon a cabinet approval could help OMCs overcome these losses.
All right. Interesting story there, Timsy. Thank you very much for that. We'll take a quick commercial break here. We'll focus back on the market with some trades with Mitesh, but we also have an interesting primary market company coming up in just a bit. Stay tuned.
Welcome back. Okay, now the market has chosen its color for the morning, and the color is red, 50 points lower on the Nifty. Let's go across to Mitesh for some trading advice. Mitesh, on the index, first of all, looking at this opening and now where it's settled, what would you do? And of course, stock ideas as well.
Morning again, Survi. I've been totally avoiding the index, and you can see that, while it's a 40-50 point kind of move, in percentage terms, it's hardly anything, and the market is still showing signs of contraction. But on stock side, I think a lot of technology names are giving you negative signals. So I think I have chosen HCL Tech as one of the sell calls. Keep a stop at about 1676, look for targets of 1620 to about 1615 on the downside. And Nykaa is seeing good follow-through action. So that's a buy, continuation buy. Keep a stop at about 211.5, look for targets of 225.
Okay, Mitesh, come back to you later. Thank you very much for joining us. We have to take one more commercial break. I have to do that. But on the other side, the management of Smartworks co-working spaces will be with us. Interesting company. They're coming up with a near 600 crore IPO.
Welcome back. Well, let's focus on some primary market action then. Smartworks co-working spaces, 580 crore IPO opens today for subscription. They have set the price band in that vicinity of from 387 to 407 rupees per share. They've also raised 174 crore rupees from the anchor investors. Let's discuss a little bit more on the IPO offering. We've got Harsh Binani, the executive director, and Nitesh Sarda, the managing director at Smartworks co-working spaces, who joins in. Hi, gentlemen. Good morning. Welcome to the stock markets and all the best for this issue. Well, let's get a basic point out of the way first before we discuss more about your business model. You're raising some money and you said you're going to be reaping some debt on that front. So tell us, what was the debt before the IPO? Once you get done with it, what does the debt come down to? And effectively, what would be the rough interest savings?
Thank you, Nigel. It's a momentous day for the company, and thank you for having us here. We are very grateful for the overwhelming support. Yesterday, we had a big anchor allocation, and we are now opening it up to public. The IPO of ours will have a primary raise of 445 crores, which will include 114 crores of repayment of high-cost debt, and the lion's share of the balance will go towards our expansion. In a post-IPO environment, the net debt of the company, which earlier stood at 299 crores in March 31st, 2025, we also had cash balances of 100 crores. Once we repay this high-cost debt of 114 crores, the company is actually going to become net debt positive.
Okay.
And today, we are very excited, especially because, as we've seen, Morgan Stanley widely reported that India is going to be the office to the world. Today, our Prime Minister Modi ji has an ambitious vision of making the country a developed economy by 2047, where the economy is going to grow to about $30 trillion. you can only imagine how much the requirement for office spaces is going to go up during this period of time. And we are here today to fuel that transformation of enterprise India. And we are extremely excited about the limitless possibilities that we are going to see.
Okay, all right. A couple of targets then. If I look at your total, I think you'll have 10 million square feet. You could correct me on that number. And it's moved from 6 to 10 million square feet in the last few years. Where is that number headed? And also number of seats. Currently, I think the capacity is roughly around 200,000 odd. So what would the ambition be? Not in the near term, but say 3 years down the line.
So our growth trajectory has been quite fast. If you look at our growth, as you rightly said, 6 million has moved to 10 million already. Just in the last 3 months, since we've declared this in our RHP, we've signed an additional 1.5 million square foot, moving our total asset under management to 11.5 million square foot. If you look at this space, Nigel, it started off about 8 years back. It's grown to 88 million square foot across India.
Yeah.
This industry generically has been able to grow faster than traditional office spaces. If you look at the projections, CBRE has said that this industry will grow to almost 140 to 147 million square foot in the next 2 to 3 years. So the potential is really, really wide. We have been able to become the largest managed campus operator in the country today. We have over 50 centers. We have over 10 million square foot of space, which is already operational, and are present in 15 cities. Our focus is a little towards mid to large enterprise clients, where we cater to their requirements of over 300 plus seats. And that's the reason we've been able to scale faster than anyone else in the market, because we take large individual buildings, convert them into campuses, and give it out to large enterprise clients.
Gentlemen, morning, and congratulations, as Nigel said, you've come into the market. Nitish, if I can ask you, what are margins like in this business, and where are they now? What do you aspire them to be? How can you grow them? What are levers here?
No. So if you look at our trajectory, in the last 3 years, margins have grown by almost 3.5 times. Our adjusted EBITDA, which stood at 35 crores in FY23, has grown to 172 crores in FY25, with a base increase of from 6 million to about 10 million square foot, and a revenue increase of only 1.7 times, from 700 crores to 1,374 crores. So while the revenue has increased by 1.7 times, our EBITDAs have increased by 3.5 times in this. The growth potential in the industry, as I said earlier, is to scale this up significantly. 147 million square foot is also just a drop in the ocean. As Harsh mentioned earlier, we are becoming the office to the world. The demand, if you look at in India for office spaces today, just the first quarter of this year had more than 48 million square foot of absorption.
Yeah.
So this
I wanted to come to that. So what are margins now
So our margin last year was at 12.5%.
Okay.
The margin has seen a steady growth trajectory. But the real strength of our business is not in our margin. We are a cash flow strength company. If you look at our margin and compare it with the cash flows, it was actually 240 crores. The trajectory that we've been able to demonstrate during this period has been on an upward curve. And every business, when you start to seed, it initially requires a lot of investment to build it to a critical mass. Once you've reached that critical mass, that's when you start to see enormous profits.
Okay, so just to office to the world, just last question, Surabhi. GCCs are the big growth driver, right? Captive centers. You have them as customers?
We service a lot of GCCs. But how I would give the sectoral mix is that India, about 55 to 60% of India's commercial demand comes from IT, ITES. For Smartworks, that number is 42 to 45. We've not only focused on IT, ITES, but we've also diversified our sectoral base by getting companies in manufacturing, healthcare, BFSI as some of our clients. So we've really distributed our client base across all sectors. And while GCC is seeing a significant amount of increase, but even Indian companies, homegrown startups who have reached a certain size are taking a lot of office spaces.
Okay. I just have a very few quick fire specific questions for you all. You said the company is throwing up about 240 crores of cash every year. Part of the issue proceeds are being used to retire debt. How much debt will you be left with, or will you be able to pay off everything, with the fact that you have cash and you've got the IPO proceeds? If you could just start there, just give us clarity.
Once we repay the 114 crores, the company will be net debt positive. What that means is that we are not going to be debt free, but the company is going to have very healthy cash balances. And we are repaying debt.
How much debt will you be left with?
We will be left with a debt of close to about 200 odd crores.
Okay.
And we are repaying debt in a very aggressive manner. And the company's growth trajectory is also starting to see massive revenue creation. In 8 years, which includes 2 years of COVID, today we are at about 1,350 crores of rental revenue.
Sure.
When you juxtapose this with one of the largest real estate companies, which has a legacy of 80 years, their
Sure.
office rental revenue is about 4,000 crore.
Okay, so you after this whole exercise, you'll be left with 200 crores of debt and roughly 240 crores of cash. Now, I just want to come to that, the model itself. How much of your campuses are owned by you and they're assets on your books, and how much are on a lease rental model? I mean, what's the thought on that going forward?
We're a completely asset-light model.
Totally asset-light.
We do not
Okay. So you
own
won't be
any of
owning
the
any of the assets.
We take it on long-term leases. That's the reason with only 500 crores of equity infused, we've been able to scale up so quickly.
Okay, so just what is typically the tenure of the leases that you take for these assets and the tenure of the contracts that you sign with your clients? I mean, typically, is it like 3 years? And, how frequently do the contracts come up for renewal?
So our tenures with our landlords are towards 15 years,
Okay.
where we have a 5-year lock-in. So post 5 years, we have the ability of moving out.
Okay.
But the total tenure is about 15 years. On the client side, we do more long terms because of our focus on mid to large enterprise clients. 63% of our revenue comes from customers who are taking 300 plus seats. When a customer takes more than 300 seats, they are happy to give you much longer tenures.
Which would be
our
how many
average tenure is about 50 months on the customer side, right?
Okay.
So it's long tenures on the customer side, but over and above that, our retention rate is as high as 86%. So even after that 50 months, 86% of the customers end up renewing.
You're welcome to the stock market and good to see the IPO. But were you all approached by anyone to buy you all out? Or, instead of listing, maybe someone proposed writing a big check to you all? Did that happen?
We have approached people to buy them out. It's a very unique model that we've created in a very fast-growing space.
But you all were not approached?
We've never.
However, having said that, we today are backed, while the promoters continue holding a majority share in the business, we are backed by a very large minority investor, which is Government of Singapore-backed Keppel Land, who own a 19% stake. They are very long-term on the business, so they in fact reduce their OFSI. So they are going to reduce to about 15%. And the company also has a list of marquee investors who have not only supported us, but reinvested throughout. So we have Madhukela Family Office, Jagdish Master Family Office, Hexaware, Polycap, Deutsche Bank. So that's how we built a great coalition, and we are very excited now as we go to the next
More details when you all list. We'll pull out some more numbers from you all, but thanks a lot for joining in and giving us all of those details.
Thank you so much for having us.
All right, well, time to slip into a short break. On the other side, our special segment, Market Masters. We'll have Lata who will be joining in. She'll be speaking to Saurabh Mukherjee of Marcellus Investment Managers. Stay with us.
Hello and welcome to a special segment of Market Masters. How will the first quarter FY26 earnings pan out? Will Nifty EPS improve going forward after a rather dull FY25? And what are the top stocks, sectors to invest in if there is a growth slowdown given the tariff uncertainty? To answer all this, I have with me Saurabh Mukherjee, founder, Marcellus Investment Managers. Good morning, Saurabh. Always a pleasure having you with us. Well, first up, this top-down question. The Nifty didn't deliver last year. Of course, there were several mid-caps which outshone, as your own portfolio shows. But what is the expectation for the current year? We have, as always, people starting with 12 and 13%. But is that even deliverable?
I think the drivers of earnings growth, even for FY26, Lata, the drivers of earnings growth are still not evident. I think the first quarter will be muted. I think it'll be another 4-5% EPS growth quarter. But it's not as yet clear to me what exactly will drive a EPS pickup in India. Both the private and government capex, it's not evident there'll be a takeoff in either. If you look at budgeted government capex or the private capex noise, it's not evident there's going to be a big takeoff in either of them. Consumption remains muted. RBI is trying its best to reflate the economy, but as I'm sure you're seeing, bank loan offtake is actually going down, not up. So the big hope I have is the India-US trade deal. I'm hoping that the India-US trade deal will galvanize Indian companies to look at new opportunities. It'll make us more competitive. From what I'm hearing, the India-US trade deal will make us more competitive vis-a-vis China in the American market. So fingers crossed in the India-US trade deal, but as yet, I'm not seeing anything which suggests to me there's an imminent pickup in earnings around the corner.
Oh, okay. Well, I'll just throw in a few things that looked positive. You had the huge tax cut, which would mean about 1 trillion for the country as a whole and maybe about ₹1 lakh for people in a certain tax bracket. As well, as you pointed out, tax cut and CRR cut as well, which will mean banks can become a little more aggressive than in previous cycles because we've not seen 3% except during COVID years.
Yeah.
And then, of course, the government's capex is not coming down. It is at a fairly high level compared to historical standards, though I agree that it is not rising at a pace that one would like. You don't think all this is enough to engender a better earnings growth than last year?
Sure. So let's focus on the consumer piece first, right? One of the reasons I've been very circumspect about a consumer demand recovery now for the last year is high levels of debt. If you leave aside home loans, if you leave aside mortgages, on household debt as a percentage of GDP. Leave aside mortgages because in India, mortgage debt, home loan debt hasn't really risen materially in the last 4-5 years. Right? Household debt to GDP is around 33-34%. That's the highest ever by Indian standards, and it's amongst the highest in the world. And there's plenty of data from the RBI's financial stability reviews to suggest that a big chunk of middle-class India is up to its neck in debt. Now, what that does is if middle-class India is heavily indebted, job creation engine is not firing, pay rises, there was a recent survey by a very credible outfit, I think Deloitte is the outfit, a very credible survey which suggests white-collar pay rises are at a 25-year low. What that suggests is distributing more credit is not going to be jacking up consumer demand. And ₹1 trillion income tax cut is in the broader context of consumer debt a relatively modest amount. So the consumer piece, it's not evident to me, fires very quickly. One area of optimism here, right, if you're looking for rays of hope, is the real estate conk-off, right? The unit sales of real estate has started falling in the last 3 quarters. And I've always found that when real estate demand conks off, that's when consumer demand starts picking. Because when you buy a flat, it sucks up so much of your income that everything else then is put on the back burner. So if real estate demand is conking off and all the signs are it is, that ironically could presage a broader recovery in demand for cars and consumer durables and so on.
Okay. All right. So I would assume, therefore, as your note on your consistent performers and on the Marcellus curated portfolio argues, that you are trying to look for companies with moats, companies which can sidestep the overall growth slowdown or the overall, modest level of growth.
Yeah.
You have a lot of finance companies in them. You have HDFC Bank, Kotak Bank, you have ICICI Lombard, two or three NBFC companies, Bajaj Finserv, Bajaj Finance, Cholamandalam. You still think that there is a very good chance of these companies doing well, despite the fact that they will initially see low margins and, of course, credit growth challenges?
Yes, so I think one of the reasons we are doubling down on our holdings in quality lenders, Lata, is the environment has actually become very difficult on the liability side, right? Raising liabilities, getting current and savings account has become really tough. And in that sort of environment, a champion franchise like HDFC Bank is standing out. I think it's standing out honestly head and shoulders above other banks. I think HDFC Bank and ICICI Bank are standing head and shoulders above other banks in consistently being able to garner low cost deposits. The reason for having an ICICI Lombard is relatively straightforward. It's shown itself to be very capable as an underwriter over the last 20 years or so. I would put it right up there as arguably the best private sector general insurance underwriter, and demand for health insurance, auto insurance, and property and casualty is holding up in what is a soft climate, right? Overall, the valuations piece on a good quality lender like HDFC Bank is also reassuring for us, and hence the predisposition towards the good quality private sector lenders in what is a muted demand environment.
Okay. The other two themes that I pick up from investors like you or fund managers has been hotels and hospitals, because India is becoming more a services consumer, at least the upper part of the K. You have Narayana Hridayalaya, but how do you look at this theme itself?
Yeah, so I think the hospitals piece, I think nicely picked up. I think what's happening is the government has made it pretty clear that they are not going to be building hospitals. The government is saying we are doing Ayushman Bharat. Ayushman Bharat is the general insurance scheme that the public can use to avail of healthcare. And in the more affluent strata of society, medical insurance provided by the employer, or if the employer doesn't provide it, then individual medical insurance has become the norm. And naturally, therefore, the hospital industry is booming. As yet, we're not seeing a supply of high quality beds exceeding demand. There's still a deficit of hospital beds in cities like Bangalore, where Narayana is particularly strong. And I would submit to even the city I live in, you and I live in, Mumbai. There's a deficit of high quality beds. In due course, there will be a supply side response. As we know, every private equity company, every private equity investor in the country is building out a large hospital chain. So in due course, the supply-demand mismatch will be closed. But until such time, I think private sector hospitals will be a good play. In hotels, the big supply shortage seems to be corporate hotels, right? So corporate hotels in cities like Bombay, Bangalore, Hyderabad, Chennai, there seems to be a shortage of corporate hotels in business districts, and we're trying to capitalize on that. We're making an investment. We haven't yet fully built the position out, so I'll hold my horses there. But there does seem to be a shortage on hotels and 3-star, 4-star hotels in business districts, and it's very difficult to get permissions and set that up, and especially in southern India, where the GCC piece is booming. Global executives are coming to India, but there aren't enough beds. We think there's money to be made there.
Okay. So you also endorse the hotels and hospitals view. You're seeming to bet on the home building materials. You have Asian Paints, Astral, Pidilite. If you're not very confident of more homes being bought, how does this tie in? And as well, Asian Paints now is no longer the monopoly it was. It is barely first among equals.
Right. So let's address the link between home building and home building materials. Barring Astral, where pipes are usually required when a house is being built for the first time, barring Astral, the other two names, Lata, the paint companies and Pidilite as a play on adhesives, waterproofing, there the link isn't as tight. So 80% of paint demand in India is driven by repainting of houses. It's the maintenance of houses rather than the first time build which drives those industries. In Astral's case, I agree that if home building is slowing down, then there is an impact on Astral's demand offtake. Now coming to the point on Asian is no longer a monopoly. The market share taken by the new entrants is actually de minimis, which is why I guess they're complaining to the authorities. And this has been true for the last 20 years. I don't have data prior to that, but whatever I've seen and read about Asian Paints this century, lots of people have tried to take them on. People have large players from across the world have come and pumped billions into taking on Asian Paints, but they haven't got anywhere. And the usual sequence is come, spend money, complain to the regulator, and then 5 years later, pack up your bags and go somewhere else and try somewhere else. So we're following the time-tested sequence in Asian Paints. And since it's a time-tested sequence and market share gains for new entrants are limited, we are sticking to our guns and staying with a large position in Asian Paints. And I stress again, I'm invested in this stock through our portfolios. So are my parents and obviously our clients.
Okay. Well, how do you see the EPS growth in your select companies? I mean, even you have given us a table of FY19 to 24 and FY25. And even over there, one has seen the EPS growth fall. It is still good at 13% for your weighted average companies in the CCP, consistent performers. But it is still lower than the 22% you generated from FY19 to FY24. So is earnings growth... what's the trajectory?
Sure. So it's a lovely point you bring out. I think overall corporate India earnings growth is down to 3-4%.
Yes.
Even our investee companies, which used to compound 20% plus, are only compounding now in the low teens, right? But what I've seen in India historically, Latha, is it's when growth evaporates. It's when growth evaporates in the country at large. That's when the market flocks to. That's when the market flocks to quality. So if you think back to the period 2017, 18, 19, the pre-COVID world, right? Growth was tepid.
Yes.
You had those debacles in the lending sector, Diwan Housing, ILFS, and so on. So growth was tepid and quality did really well in those three sectors. In the post-COVID world, growth was abundant, right? There was revenge spending, there was heavy-duty government infra spending. Growth was abundant and quality took a backseat. It's only in the last 6 months or so, as the growth environment has become soft, that's when quality has started staging a comeback. That's when, for example, a stock like HDFC Bank has started flourishing again. So ironically, a low growth environment is bad for everybody. Even our companies suffer in a low growth environment, but because our companies suffer relatively less compared to the broader index in a low growth environment, this is exactly the sort of circumstance in which quality stocks start flourishing in India.
Okay. I do want to take up with you what will happen when the trade deal is announced. You said that you're expecting much for India, but that discussion another day. Let's hope that by the time we meet next time, we will have the contours of the deal with the US. Fingers crossed. Thank you very much, Saurabh, for a many-sided discussion on several sectors and the path going forward, both for GDP growth and EPS growth. Wrap up on Bazaar on that note. Chartbusters coming up.